All right, welcome to Wealth Webinar Wednesdays. My name is Stephen Nagy. I'm filling in for the Chris Naugle today. Chris is down in Mexico at a mastermind, developing new relationships and building our network. So thanks, Chris, for putting in the time and the hours and traveling and going where you need to go to make things happen for Money School and Money Multiplier. So I'm here today with Shauna Decker, who will be answering your questions and responding to you in the chat box. And thank you for everybody for being here. So today is going to be a bit of a continuation from what we went over last week. So if you happen to miss last week, make sure you go to youtube.com/the Chris Naugle and you can watch the replay. It was just posted, I believe, yesterday, the replay from last week. And last week, what we did is we kind of brought you on a journey of what it's like to be, take back control of your money and start doing things like private lending and, why real estate investing might be a really smart play right now and place to be able to grow wealth and build your money while the stock market's at all-time highs and Bitcoin's breaking records. Bitcoin, I don't know where it's at right now, but it looks like it's still up there. So Bitcoin actually broke out and is at all-time highs, what traders call ATH, all-time highs right now. So things are going crazy in the economy, the stock market, crypto, real estate markets. So how do we manage that? How do we manage what's coming up in the future? And what do we do to protect our money right now, but keep it growing? Because if you guys are following, today's October 20th, 2021, inflation is through the roof right now, right? So I'm not going to get into all that. You guys have seen our rants on what the F happened. You've seen some of our other webinars and trainings that we do. So we're going to dig right into this. So today's a continuation from that journey of why private lending, why real estate, why the Private Money Club, into more of the details. So today I'm going to talk a little bit about how to evaluate deals, how to use what's called the perfect loan proposal and why. So last week was a lot of the whys. This week is a lot of the how and the how-to. So we're going to get into mortgages, promissory notes, deeds of trust, the rules for doing private money lending to make sure you're doing it right every single time. And more importantly, your money is protected every single time. So even, one of the best things about private money lending is even if things go drastically wrong and the entire deal falls apart, if you have it set up the right way, you still will protect your money and oftentimes even still profit from that deal that completely fell apart the way that it was designed to do. So we're going to get into that stuff today, and I'll throw out some little pointers along the way. And then let's go ahead and start with, let's just do a quick review of what we went over last week. So last week we talked about different types of real estate and different types of deals. So I'm just gonna just a real quick 5-minute recap of what we went over, so everybody's on the same page right now, because this setup is gonna directly impact what we talk about over the next hour today. Okay, so we have short-term and we have long-term real estate deals. Okay, so whenever we're evaluating real estate and real estate deals, and we're starting to think, okay, how do I want to invest my money? And remember, we talked about all these different things like single family residential, so your single family homes that are out there, multifamily. We talked about, which are multifamilies like apartment complexes. We talked about mobile home parks. We talked about RV parks. We talked about storage units. We talked about land. Right? So we talked about all these different types of real estate asset classes that you can be involved in that are all under real estate, right? And we talked about how whether real estate's going up, down, sideways, and how we're able to kind of predict what's upcoming to position ourselves for the right type of real estate and what kind of real estate to be in for this market we're in right now, where prices are on all-time highs, right? So maybe stay away from the flips that are longer term and stick with the shorter term ones, right? Or maybe multifamily and mobile home parks, when the market starts to downturn and foreclosures come and people are losing their homes, they still need a place to live. So maybe those are good asset classes to be in when that happens, right? So we started talking all about that and thinking about what types of investments do we want to do. All right. And then we talked about passive. So we talked about passive versus active investing, right? So passive investing is me with $100,000 in the bank, and Shauna, who doesn't have $100,000 in the bank, but Shauna has the drive, the education, the motivation to go find a house, negotiate the deal, put it under contract, put the deal together, put the team together to rehab that property, fix it up, and resell it for $150,000, right? But Shauna, to do that, needs my $100,000 to be able to get that deal done. So as a passive investor, I sign a contract and she signs a contract and I give her my money. She does all the work involved as the active investor. And then throughout the time, or once the deal's done, she pays me whatever the terms are on that contract, which we're going to get into with promissory notes here in just a minute, what those terms look like and what they are. And then her as the active investor, she sells the deal, cashes me out, and she makes the blunt of the profit, right? So let's say she paid me 10%. I made 10 grand. She sold for 150, bought it for 100. She made 40,000. It's a win-win situation. Everybody makes money on the deal, right? So active versus passive. So what type of real estate do you want to be in? Are you going to be an passive or active investor? And then do we want to look at short-term or long-term? Because all of these different types of deals that we're doing, we can do short-term or long-term, right? If you guys join me for Money Club Mondays on this last Monday, I had Luke Medico on with me. And if you guys were on that one, we talked a little bit about short-term versus long-term with the same deal, okay? So he had a triplex. So Luke had a triplex he was buying for $95,000, worth $140,000. It cash flows. It was $1,850 a month with 900 and some in expenses and 900 and some in actual positive cash flow profit coming in each and every month. So we talked about the ways we could do this. We could do this with a short-term loan from a passive investor and do what's called the BRRRR strategy. Okay. So the BRRRR strategy would mean I would give Luke my $95,000. He would season that property for around 6 months. And then he would go and he would refinance. He would refinance that property at a bank, cash me out the $100,000 I lent him, and then that property would be on a long-term note with the bank's money. So from a passive investor lender standpoint, that's a short-term deal. But we also talked about how we could take the same deal right here and we could position it through a private money lender long-term. And what that would look like is he would pay maybe a different interest rate, but instead of refinancing the property, instead of doing that, he would keep the private money lender on the deal long-term. And maybe that's 5 years, maybe that's 15, 20 years, maybe that's an amortized loan, maybe that's a lower interest rate loan, and you get some equity in the deal. I mean, how many of you, instead of lending getting 12% return on your money, how many of you would lend at, let's say 6%, but you would get 10% equity in that deal? So you're growing your money at a lower rate guaranteed through the private money note, right? Through the interest being paid on that $100,000. But on the back end, when you either cash out through a refinance in the future or sell the note, notes you can buy and sell. So you sell the actual note to somebody else, or you just sell the property and cash out of the deal, but you would make a lot more money potentially on the back end by sharing in the equity on that deal. So we could take the exact same deal and we could set it up two different ways. Does that make sense to everybody? You guys following short-term versus long-term? And then not only can we position, single flips that way or single transactions that way, but then we look at, okay, just to take it one step further. And again, this stuff is important because when we start getting into negotiations and terms on promissory notes and what the mortgage looks like, this is what you're going to discuss. If you're a passive investor, this is what you're discussing with the active investor. If you're an active investor, this is what you're trying to present and show the passive investor ways to set this deal up to make it make sense, right? All right. So the other opportunity. So I'm going to relate this back to Private Money Club as we go too, because I'm going to assume most of you are going to join the Private Money Club and you're not out here doing this on your own at local meetups and things like that. But that's what the Private Money Club is for. So in the Private Money Club, we have those flip deals. Try that pen here. So we have the flip deals, that are 3 to 6 months. Okay, so those are great, 3 to 6 months. You do them over and over and over again. And then we have private funds. That can be 3+ years, not months, but years. you know? So, you know, maybe one pays 12%, maybe one pays 10%. You know, it just depends. We do have, you know, 3-year private funds right now that would pay you 12% annually on them. So they range all over the place, but it's just in your head, you know, what am I using the money for, short term or long term? You know, where is it coming from? Again, long term, I'm a big fan of using, you know, for long-term deals, money that's in like a retirement account, qualified funds. You can't touch the money anyways until retirement. So why not real passively just make the investment, set it and forget it for 3, 4, 5 years, and just let the retirement account build and build and build. Then that way you're not thinking about it. Short term though, maybe you don't want your money sitting and losing money to inflation. So you need it growing, but you don't want to give up control of it for longer than 6 months because maybe you think that foreclosures are coming next year or in 2 years. So you want access to your money, your principal when that happens, so you can actually go out and buy active deals yourself. So maybe that's when a passive investor flips over to become an active investor again. And I have many members in the Private Money Club right now I've been talking to that were active investors in the past, and now they're becoming passive investors. And those are my favorites. You know, that's like your Chris Naugles, because they've been on the active side. Same thing with me, been on the active side. So we understand where that flipper is coming from or where that active investor is coming from. So we can make the deals happen a lot easier as now a passive investor. So we've been on both sides of the fence. It's very similar like when I was a financial advisor for a couple of years and I learned the traditional ways of investing, your mutual funds, your 401ks, your traditional whole life insurance or term policies versus what we do now with real estate investings and alternate investments and private money lending and self-directed IRAs and specially designed and engineered whole life policies built for infinite banking concepts. So I've been on both sides of the fence. So it's very easy for me to explain pros and cons, pluses, minuses, you know, strategize, you know, what's the best route for you to take. Because what we do with Private Money Club, private lending, it's not for everybody, okay? You have to be willing to hop on webinars like this and learn. You have to be willing to open your mind to something new that's never been taught to you in high school, in college, in you know, traditional education. This is stuff you have to go out there and seek and find websites like youtube.com/the Chris Naugle. Subscribe to those, hit the alert bell. So every time a new training comes out, you're alerted and you watch it and you're continuing your education, because it's very, very easy to go to a 3-day seminar or go to a training like this, get real hyped about it, and then what happens? You kind of lose all the motivation. You lose the hype around it. Then life, you get back into life, back to your regular job, back to your family, back to coaching sports, back to whatever. And then all of a sudden you forget about it. You're looking back a year, 2 years, 3 years down the road, and you say, oh man, why didn't I start with that back then? Now my 401k's fallen in half. I haven't taken advantage of anything. It's just a snowball effect on both sides of the fence, right? So it's very important to, you know, you have to have that motivation. And those are the people that we love working with, those that learn it and not only learn it, but learn it and implement and take action. And that's what this is all about. And that's one of the reasons I talked to Shauna yesterday and said, let's just invite everybody to the Private Money Club. Let's see how many people take action and actually open up accounts and start doing some of this stuff that we teach. And all of you that join, there's 6 videos on the Private Money Club you can watch right away that have to deal with private money lending and the basics that Chris and I put together that are just a lot of fun to watch too. So make sure you check those out whenever you guys log in there. All right, we're doing good, Shauna. I'm not really reading the chat, so just let me know if anything comes in or make sure they go in the Q&A box so I can hit those as we go. All right, so let's go to talk about how to start evaluating these deals. Because whether you are interested in, you know, doing these private money loans short-term, whether you're looking at doing long-term private money loans, whether you're a active investor putting together these flips or putting together these deals to present to passive investors, all of you need to understand how to evaluate the deal, put the pieces together, and then how to present that to somebody, whether you're presenting it to the lender as the borrower, or if you're the lender, you're listening to what the borrower is showing you. You need to understand this stuff, all right? So what we've done is we put together basically everything you would need to begin doing this, either as a passive or active investor within the Private Money Club. So everything I'm showing you here today and talking about, you get included with your membership, with your premier membership to the private money club. So you're going to get all of this stuff and you're going to have immediate access to all of it to start using yourself right away. So I'm just highlighting everything pretty much that you're getting right here. We have training in there and how to use it. And that's what I want to get into right now today, as well as more of the training on how you're going to start using these tools to evaluate these deals. So one of the tools that we are going to give you. And if you've ever been to one of our 3-day trainings before, if you've ever been to Money School Essentials, you have gotten the file vault. And if you've been on any of our previews, we've gone through these in a little more detail in the past. So I just wanted to highlight them right now, and we can send you the training for those. But let me show you what I'm talking about here. All right. So all of you in Money School TV, MSTV, and the Private Money Club, you're going to have access to these what are called file vault tools. Okay. So these file vault tools are what you're going to be using as an active investor. And just so you guys know, these are tools that Chris and his team put together when they were flipping hundreds of homes. You know, Chris had his own show on HGTV at one point called Risky Builder, and they had flipped like 260 some houses at the time. So they had, you know, at one time, like 6 to 8 different crews going all at once. So when they would go in to evaluate a deal, they would need to be able to run the numbers on that thing and basically make an offer right there on the spot to the seller. Right? Because when you're doing that many properties, you really got to be efficient with your time. And the way to be efficient with your time is to be able to quickly look at that property, evaluate it, get the numbers, and show the seller why you're willing to pay them $120,000 for that property instead of what they're asking, $160,000, and have the backup on why you're making that offer and why the property is going to sit on the market if they don't do this cash deal with you right now. Right? So, or whatever the case might be. So having these tools in the field, being familiar with them are very important. And then from the passive side, you know, if you have a borrower that's presenting a deal to you and they're telling you, these are the numbers, this is what we're buying it for, this is what the rehab costs are, these are the closing costs, this is, you know, what the holding costs are, you know, they're showing you all the numbers. You as a private money lender, wouldn't you like a quick way to be able to go in and evaluate that property and quickly verify the numbers and quickly run your own calculations? Because then you could go to that borrower and say, okay, yes, I agree with what you're saying. I double check the numbers. It all makes sense. Let's do this. Or, hey, I notice you're, you know, you kind of forgot about the closing costs. You forgot about the holding costs, or you forgot about, you know, the insurance on it, or whatever the case might be. And then, you know, so that way you're not over lending what the property's worth, right? So very important that you're able to analyze these deals when you're lending money on them. All right. So inside of the file vault, you're going to have these different tools. So a cash flow deal inspector, you have something called the max offer form, closing cost estimator, the property spec sheet, I'm going to go over in a minute. It's part of the perfect loan proposal, actually. You have a property repair estimate sheet. You have a property rehab strategic checklist. Again, lists are important because if you have a million things going on in your mind, you don't want to overlook something very important. So having checklists and having a system in place to do this every single time, it'll allow you to never forget important steps that you need to take every single time. Private lending packet, you also get the credibility builder. So the credibility builder is something you can put together that you can use when you're attracting new private money. Maybe you're talking to friends or family or you know, associates, people, you know, professional experts, things like that. The credibility builder is a great little template you can have with you at all times that talks about you, your company, what you've done, things like that. And then the perfect loan proposal takes that to the whole nother level and combines it along with a lot of these tools. So I don't want to get too in the weeds on this. You know, like I said, all of you have access to this and we have in-depth training on all of it. So I just want to, let me just maybe show you, let me see if a couple will open real fast. And then everything else that I have. So what you do is you just click on it. It opens it up so you can preview it, and then you can hit download. It'll download it right to your computer. All of these forms and templates and everything in the file vault are all fully customizable. So max allowable offer guide. So this, and again, this is stuff you can all change. So you click that, you put your company logo in. It kind of tells you how to use it. What is the maximum allowable offer? So this is for like an active investor that's out there in the field. They can input some numbers on here. So you can see you can input these numbers real fast It's going to do the math for you, and then it's going to give you your maximal allowable offer, or maximal allowable offer if you're assigning it. So if you're a wholesaler, you can know what you can offer, building in the wholesale fee or the assignment fee that you're going to charge somebody else to do that. So, and you can change, what the average taxes are, prices are in your area and things like that. So again, these are pretty simple documents, but they're very important to have. And Chris put these together and built them specifically for being out there in the field. This is a good one. Let me just open this one and then we'll move along here. So the closing cost estimator, the property repair estimate sheet is really good too. So these are one, so you click it and it downloads it right there to your computer. Let me see if I can just open one real fast for you guys. All right. And then, all right, so while that's opening up, let me share my screen here, stop my screen. Okay, let me just check the comments and the Q&A box real fast. All right, it looks like Q&A is good. Shauna, we're good on Q&A? All right. All right, send you the link for price. So yeah, so we can do that. Shauna put the quick start guide, perfect. Q&A guide, awesome. Join the price, okay, got it. Okay, yeah, and if you guys have any actual questions, just put those in the Q&A box. All right, Shauna, thank you. Looks like you're keeping up with everything perfect right now. All right, so let me just open up these quick documents and show you guys these, and then we'll move on to the perfect loan proposal for you. All right, so this is the property repair estimate sheet. So again, it's just something you can quickly fill out while you're out there in the field. It's going to, remind you of things, what's the roof look like? What's the paint look like? Windows, garage, landscaping, plumbing, electrical, foundation. So, you go through, carpeting, what's the flooring look like? And then in your area, you can kind of input, what that cost looks like in your area. And then you can have some quick estimates right there, and then put your final cost depending on what it needs over there. It'll add it all up for you, get your total cost. So just again, a real quick, easy way to have a checklist and something that you can use over and over again while you're out there in the field. And then I'll show you one other one. All right, so let's go ahead and pop up. Let's move on now to the perfect loan proposal. So the perfect loan proposal is going to be basically what the perfect loan proposal is everything that the bank would ask for and want to know about you, your company, your experience, your credit, everything about you and everything about the deal to make an educated decision on whether or not to lend money on that deal. So the perfect loan proposal is basically the exact same thing that the bank would ask for, except on a personal use basis. So if you're a borrower, the first thing you do when you join the private money club is you are going to put together your perfect loan proposal. And this is what you're going to use to get all the money that you'll ever need for all the deals that you have in the future. Because if you have this perfect loan proposal put together properly, me as a lender, the other lenders in the private money club, when we look at that, that's the first thing that we're going to see that's going to make us decide, hey, do I want to have a conversation with this borrower or not? So the better that looks, the more truthful and honest and just, the information in it. It doesn't have to be pretty. I don't care about that. I don't care if you just have thumbnail images on there for everything, but the information inside of it is very, very important. So this is what I want to spend a little bit of time going through the perfect loan proposal. So I'm going to pull that up right now. All right. Okay, here we go. Sorry, it went up into the cloud. So it's just downloading right now. As soon as it downloads, I will open it up for you guys. It looks like about 30 seconds. All right, so while they're doing that, I see two questions come in. Noticed a stove price and wondered if the amounts have been updated for our current stagflation economy. Jim, they haven't. And one of the reasons we haven't really updated the prices and stuff on the templates is just because it is changing so quickly right now. I mean, lumber was through the roof. It's came back down a little bit. I hear it's kind of up back again right now. So things are happening so quickly. And on top of that, depending on where in the country you're located, that's going to make a big difference. And then, who your contractors are. Like, we work with contractors on some of the new construction deals that we're doing, and these contractors are getting supplies like nothing ever changed. but maybe you have another contractor that doesn't do as much work and they're backed out 6 months and their prices are up a lot higher. So just because of geographic locations and what's happening right now, we haven't really updated that stuff too much. So just double check that for your area and exactly what you're looking at. Sean asked, do I use that to present notes too? Yeah, you can use these deal templates. You can use these perfect loan proposals to present anything pretty much. Absolutely. All right. All right. Looks like this is downloaded and it is pulling up now. All right. All right. The perfect loan proposal. Now this is when you're filling out, it's going to come in two sections. So we have the perfect loan proposal and the deal template section. So we break it up this way on purpose. So again, in the Private Money Club, what you're going to see is people posting deals. So right now, like the highlights of them are posted in Slack. As we import people into the Private Money Club and you guys start to join privatemoneyclub.com, there's actually a place on there where you go to list a deal and you're going to fill it out just like Zillow, the address, the deal details, the purchase price, the work. So all that stuff is templated out in perfectmoneyclub.com. So when you go to list a deal, you just follow the directions and then that deal is going to pop up in Private Money Club. And then me as a lender or you as a lender, you can search deals. So if you have $50,000 to lend, you're going to search parameter $50,000 and less. If you are looking for a specific area, you can search that specific area. So you can search different ways depending on what you're doing, depending on what how much money you have to lend out, and vice versa. Borrowers can actually search lenders. So if you're a lender profile on the privatemoneyclub.com, you're going to be able to list how much money you have available now, how much money you have coming up in the next 6 months, and some of these various details. What kind of deals are you looking for, short-term versus long-term? And that way borrowers can search and seek you out as well. Because if I have a pocket listing coming on or something like that, and I see a lender has $100,000 coming up in 2 weeks, and I need that money in 2 weeks from now, I can reach out to them and say, hey, I got a deal coming up in a couple of weeks. You want to go ahead and get this thing secured before I even list it for the open market on privatemoneyclub.com. And then we have wholesalers bringing properties in right now. So you're gonna be able to search wholesale deals if you're looking to actively buy flips or actively buy rental properties. Wholesalers are gonna be listing their deals in there. So there's a little something for everybody, whether you're a borrower, a lender, an active or a passive investor. So this perfect loan proposal, this is fully customizable. So when you get it, it's gonna look very similar to this. So you're gonna put your company information, maybe your name right here, maybe your address, maybe your company logo can go right there. It's very easy. So you can do this using PowerPoint, using Keynote, whatever software you have on your computer. I believe it even works in Google Slides as well. So you can fully customize it by just kind of hitting delete, importing the new picture. It's very easy to do. And if you need any help, I'm sure somebody out there can help you get this done. So I'm just going to go through it. So we have the table of contents for the perfect loan proposal. Again, this is the first thing you're going to look at. So all about you, all about your financials, and then we're going to get into all about the deal. So credibility piece, list all your real estate. So your experience, your personal financial statement, your LLC, corporation docs, 3 years of tax returns, credit reports. Again, this is stuff that a bank would ask for if you were getting a loan traditionally. So why, as a lender, would I not want to know this information as well? Now, if you don't have a credit report or you don't have an LLC set up or something like that yet, or maybe this is your first deal, you haven't done any real estate deals yet, it doesn't matter, okay? When you create your perfect loan proposal, you're in control. So if you don't have that stuff, just don't include it in there, okay? It's not the end of the world. If this is your first deal, then tell about what else you've done in the past. Maybe you have never flipped your own house, but maybe you've been doing construction, working on homes for 20 years, and you know more about the cost of goods and how to evaluate and get a flip done better than somebody that's done 20 flips just because you've done it for 20 years. You've just never been on the investor side of the fence. So just because you don't have experience doesn't necessarily mean it's a negative, right? So put on there what you do have. If you haven't pulled your credit reports yet, or you don't have your tax returns back yet, don't stop. put that perfect loan proposal out there, start sending it to people. And then if I'm interested in it and that's a deal breaker, I'm like, well, I have to know your last 3 years tax returns, or I have to know your credit report before I'm willing to lend on this deal. Then get it done at that time. But I'll tell you what, I can't think of the last deal that I lent on that I cared about the credit of the person, because I'm primarily lending on who that person is and what the deal is. If I know them, I don't care what their credit looks like, what happened in the past. So there's more to it than this, but this is a great place to start and give you a template to say, if you want the ultimate proposal, do this. And you can literally, even if you did want to go refinance, like if you're following the Burr method and you want to cash out of a deal and go get traditional financing, great. You can literally take this perfect loan proposal, go to the bank, meet with the banker or with the loan officer, just sit the perfect loan proposal down and shut up. I guarantee you, they're not even going to ask you any questions. They're going to start looking through it and they're going to be like, holy shit, I wish everybody had one of these. We're going to lend to you, no problem, because everything we typically have to ask for and wait weeks and weeks and weeks for people to bring back to us, you have right here for me right now. You're going to bump to the top of my VIP list. So things like that, right? So you're able to use this thing over and over again. All right. So let me go down through what some of this looks like. So again, we give you kind of like the headers and just some different comments and ideas. And then you can go through and put your information. And if anybody wants, like if anybody needs help with this, I can send you like a completed one that other people have already put together with their company information and stuff like this. Or if you're, if you're in the private money club, just go in there and look around at other perfect loan proposals and get an idea of how to build yours and do yours. So this template right here will kind of give you some pointers on what to do when you're putting this together. So tell us a little bit about you, the industry, your company, what your objective is. Are you flipping houses every 3 to 6 months doing short term? Are you doing long-term rentals? Are you following the Burr strategy? Like, what's your objective when it comes to investing? What are your goals? Things like that. And again, look at other people's, because if you look at other people's proposals, it'll give you some really good ideas. And I've seen some really good perfect loan proposals out there that people have put together. What's your vision of your company? And that's important. When you put together your LLC and you put together your team, your power team, your contractors, people that are going to do the work, your realtors, your loan, everybody that's involved in your power team, your core team, what's your overall vision? Like, what's your goal with all of this? And that's stuff that people want to know. It gives me insight into who you are. Like, why do I want to lend my money and do business with you versus the next guy, right? What's your vision? Do we align together? Things like that. So the leadership, who's in your company? So are you the CEO? Do you have a proper property acquisition specialist? Do you have, somebody that puts together the numbers? What is their role? What do they do? What do they look like? And just tell us a little bit about them. If it's just you, no problem. Just delete the rest of this stuff off here and just put you on there. So again, it doesn't matter. These are just ideas for you to use this thing. What are your company numbers? How long have you been in business? How many deals have you flipped over the last 12 months, over the last 10 years? How much money have you raised? If you're a lender, like, think to yourself, how much money have I lent out before? Like, all this stuff, right? So pivotal operational principles. So again, just different things that set your company and what you do apart from other people. If you don't have any of this, or you don't really want to add this right now, just delete it. You skip the slide, right? So hit skip slide, and all of a sudden nobody even knows it was there. So when you present it, nobody will even think about it. So no problem there. Again, just principles, what is that? Why employ us? So what do you offer that others don't? So as an example, if I was to show you Steve Lawson's perfect loan proposal on this section right here, he offers 10% interest annually on lending money, or 20% profit on the deal. Does that set him apart from other borrowers? Absolutely. People love being able to get 20% profit instead of just a flat 10 or 12% interest. So what sets you apart? Luke Medico, we were talking about this long-term. If somebody did that, he would offer, a lower interest rate, but he's willing to offer equity on the deal. So maybe we'll write this in here. Long-term deals, let's develop a partnership where you have equity in the deal. So different things like that, that you can put on here. Again, that sets you apart. Unique business proposition, investment strategy, and techniques. So So again, just all the different stuff that you do, how you guys operate. Do you have a, text message marketing? Do you have an internet marketing company that you work with? Like all this stuff, just tell us about you and your company. Why are you creating passive income? Is it for your family? Is it for your kids? Like get personal with it. I mean, that's part of the fun of this business is developing relationships. So why not start putting yourself out there a little bit right now and get to know each other? Private loans secured by mortgages or real estate deals. So this is, if you were giving this perfect loan proposal, for example, to somebody that was brand new at private money lending, maybe they just have some simple questions. So we added a simple Q&A in here, like, what is a private loan? It's a loan made to a real estate investor that is secured by real estate. Private loan investors are given a first mortgage that secures their legal interest in the property and secures their investment, which that's what we're going to get into next, mortgages and promissory notes. So it kind of just gives them a little Q&A, like, why are you doing this? What are the advantages for me? That kind of thing. So we've tried to think of everything to put in here that would help, as a borrower to present to a lister. And then these are deals that you've done. So again, just you told them up above here about your experience. Now you're proving it. What are deals you've done in the past? Flips. What are wholesale deals? What's your rental portfolio look like? If you're in construction, maybe you've just worked on hundreds and hundreds and thousands of homes in the past, or maybe you're a realtor and you're really good at negotiating. You've never done flips, but now you're going from the realtor side to the investor side. We'll put that in here. I did $5 million in real estate transactions as a realtor in the last 5 years, or I've closed 150 houses, or maybe you're a loan originator and you've done loans, so you're good on the money side. But put it as, whatever you are in there. Your personal financial statement. So again, now we're going to get into the personal section. So this is going to get into, how much money do you have in your bank account? How much are you worth? What's all that look like? And again, this isn't necessarily a deal breaker if you're brand new or anything like that. But me as a lender, if I see somebody that has no experience and they don't have a lot of money, they're brand new, to me, that just increases the risk a little bit. There's nothing wrong with it. It just increases the risk a little bit. So anytime I'm evaluating risk versus reward, if I have higher risk, I want to have higher reward, right? Meaning when I'm negotiating this contract and the terms of it, I'm going to maybe ask for, instead of lending my money at 10%, maybe I'm going to lend my money at 15% and 2 points up top. So then the borrower has to decide, hey, am I willing to give up a little bit more of this deal to be able to get it done, to build my experience? Or do I want to go out there and do it on my own and not use private money, right? So they have that choice then. So this is all stuff that, me as a lender, I'm looking at as I'm looking through this perfect loan proposal. What's that risk level? And then that'll help me, once I decide if I want to do business with that person, how I'm going to negotiate those terms and what that reward is going to look like. So that's what all of this is designed to do. So now that we've gone through the perfect loan proposal side, and you just find out a little bit about who that person is, who the company is, what their experience is, and what their vision is. Okay, that checks off all the boxes. I like them. I trust them now a little bit more. I'm starting to get to know them. Now let me look at, what are they trying to sell me on? What is the deal? What am I actually lending my money on that's going to be providing, the profit to me? So, and it's very important, the human part as well as the deal part, right? Would you guys all agree with that? All right. No jerks allowed. Absolutely, Shawnee. All right. So let me pull up the second part of the perfect loan proposal now. Okay. All right. So like I said, now we're going to start getting into what is this actual specific deal. So when we look at the overall perfect loan proposal, that first section right there about you, your details, the company, all that stuff, you can fill that out and create that one time and use it over and over and over again for all future deals. Obviously you're going to update some of the numbers in there, your experience, recent flips, how many deals you've done, maybe your strategy is changing, maybe you were doing a lot of luxury flips, and now because of the market, you're going to narrow it down to more quicker flips, more single family, like, affordable type housing, so maybe your strategy or vision's trained a little bit. I talked to a lot of people that are moving on right now from doing a lot of flips to starting to build up their long-term portfolio, their renter portfolios. So as that changes, maybe you're going to update your perfect loan proposal, but for the most part, you're going to create that and use it over and over again. Now, this second part, dealing with the property itself, is the part you're going to change on every single deal because you're going to be presenting for new deals every single time, right? So this is, let me scroll up to the top here. All right, so the property lead sheet. So put a picture of the property, put the address of the property, what are the features, how many bedrooms, how many baths. Down here in Florida, something like CBS construction would be, a feature of the property versus a stick frame house, a wood frame house, a fenced in yard, depending on where the property is located, that's the stuff that you want to feature on that property. What are things that immediately when I see that, I like to see? And then, what's the price of the property? So you have an idea. I mean, if it's a $900,000 home and you have a couple $100,000 you're looking to lend, you can immediately say, okay, this isn't the deal for me. Maybe I liked everything else I saw in that perfect loan proposal, but I just, so I'm going to reach out to that borrower and say, hey, if you get anything in the couple $100,000 range, let me know. I'd like to do business with you. But this one you have right now for 900, that's out of my range right now. So you just know to move on. So put that basic information right up there that I can see it and know exactly what's going on. And then we're going to get into some of the actual details. So again, the same property, what is, so it just gets into a little bit more specifics. What's the description of it? What's the estimated age of some of the different things in the property, like the windows, the roof, the furnace, the air conditioning, the electrical, what's going on in the neighborhood. So how many properties are for sale within the neighborhood and what do the comps look like? So comps, CMAs, comparable market analysis, BPOs, broker price opinion, that's all the same thing. And what that is so you can just quickly put on here what some of those comps are. And again, if it's a 3-bedroom, 2-bath, 1,600 square foot home, you're going to want to look for other 3-bedroom, 2-bath, 1,600 square foot homes within the general area. Okay. So that's when you need to know a little bit about the local market or have a strong realtor in your power team that can provide you that information very quickly. One way to pull comps and do it very well is through Flipping Edge. So we actually have a software program called Flipping Edge, and I highly recommend it. Actually, maybe Shauna, if you can maybe we offer a 7-day trial and we have a training on Flipping Edge, we can send that to you. So maybe we can put that in the chat box, or if you guys email me, I'll send you over the link for the 7-day trial along with the training for how to use Flipping Edge software. But Flipping Edge software is very powerful to use, and you can quickly pull up comps and get information around the area and the neighborhoods that you would need to start doing some of this stuff. So multiple ways to do it, no right or wrong, just different styles. Some people love pulling their own comps. Some people love using realtors to do so. But this is going to give you that quick data just to ensure, hey, if I'm looking for $145,000 to buy this house and all the comps are selling for $240,000 and it only needs $20,000 in work, then hey, I know I got something that I want to look more into. So I like the person, I like the initial thoughts on what this house looks like and the initial specifics. So let me keep going to see if I want to, learn more about it. So this just gets into it even a little bit more closely. Again, this is using some of those file vault tools built into this perfect loan proposal. So what are the property? And these are things that people forget. So that's why I love this. Again, you don't want to forget anything as the borrower, because then you're going to, you could think you're going to make 10 grand, forget about taxes or holding costs, and that 10,000 all of a sudden goes down to zero. Or as a lender, you thought you were investing in a safe deal, and all of a sudden you forgot, all these different parts of it. There's no money there, and it kind of makes things a little bit harder. So this is a great way to keep up with everything. So holding, carrying costs, closing costs, property taxes, all this stuff will be right here for us. And then you can see total project cost. So this is like the deal rundown right here. It just gives you a quick place to input all of that information from above into one quick little form. It'll spit out, what that's going to look like. And then we can put in what's the loan information. So if you're going to do a private money loan at 12%, or maybe you need a certain down payment, maybe they're only willing to loan a certain amount, loan to value ratio. So you put that in there and it's going to spit out what that looks like to you. And then the projected profits. And then if you get real fancy with it, you can get one of these little QR codes. So if people want to reach out to you and talk to you more about the deal, just scan that QR code you see at the bottom here and make a quick contact. All right. And then this is, again, we always want to show somebody something, but then we want to back up and prove that something. So up here in the specific sections, we were telling about how much the rehab and stuff on that cost is going to be, the closing costs, holding costs. This is going to break it all down very specifically. So you can see exactly what's going into this thing and what the repairs are going to look like, what the closing costs are going to look like, to make sure that all those numbers do add up. Again, proving what the house looks like with photos. Photos are very important. A picture is worth 1,000 words, right? So I can tell you, hey, this home has a brand new kitchen, so we don't need to rehab the kitchen. And if I have a picture that shows a brand new kitchen, I'm like, all right, awesome. But if someone tells me there's a brand new kitchen and I see a picture of a kitchen that looks like it's 30 freaking years old, I start thinking to myself, wait a minute, this isn't adding up. So the more I can show and verify, the more trust is going to be built up, and the more this relationship is going to start to blossom and is something that will actually move forward. So we have plenty of place to put pictures on different parts of the property. Take pictures of everything. The more pictures, the better, in my opinion. And then, we just have an overall, sheet, what this would look like if you were to do this deal. So this is just kind of like a summary. Oh, and just to back up real fast, I don't see it on here, but typically for comps, most of the perfect loan proposals I've seen after this section have an area where you put in the actual comps. So we talk about the comps. We talk about the comps right here. But when you run comps, you can actually print out like pages that show about the subject property and show about the comparable properties. Again, just verifying the information. So I would recommend putting those into the perfect loan proposal too, just so I can see the basics and then I can verify everything. And then this last sheet right here is just an overview, a summary of the deal. So for instance, this is a private loan, interest only, 10% interest paid monthly. This is for 1 year with an optional extension of 18 months. You can be a first or second lien position lien holder. We'll talk more about that in just a second. And then this is what the scenario would look like. Purchase price, rehab cost, total investment, sale price, return on the lender's money would be $10,000. And then what that looks like broken down. And then if you like everything you see, you can call, email, or QR code that borrower, and then you guys can hop on the phone and discuss the details. What questions do you have about it? Are you, negotiable on these terms? Maybe you don't know yet what the exit strategy is. What are your exit strategies? Are you going to flip it? Are you wholesaling it? Like, are you keeping it? Are you doing the BRRRR strategy? So you can ask those questions and find out, the further details. But this perfect loan proposal and property lead sheet proposal are the parts that you're going to look at every single time for these deals. All right. Any questions on any of that stuff? Canadian residents. Yes. The private money club would be beneficial and helpful for anybody that's looking to borrow or lend money. Really anywhere. But if you live in Canada, you can definitely lend money on deals here in the States. No problem there. Okay, looks like Shauna helped Sean. All right. I'm sorry, I missed it. Where did I find this perfect loan proposal? And also, where do I find the forms you were talking about? Dustin, it's all included in the private money club. So if you're already a member, you should have been emailed this stuff. Otherwise, it'll be in the membership area of private money club, or I can email it over to you. It's up to you. Just let us know and I'll get that right over to you, Dustin. All right. So now let's get into mortgages, promissory notes, and deeds of trust. All right. So first off, what's the difference in a mortgage, a deed of trust, and a promissory note? So I'm going to read to you guys just a couple sentences here, and then I'm going to get into and show you the actual documents. Okay. So mortgages and deeds of trust are both agreements in which a borrower puts up title to real estate as security or collateral for a loan. Okay. So a deed of trust or a mortgage, they're basically the same thing. Typically, it depends on what state you're in, whether the state uses trustees or whether the state uses mortgages, but essentially they're the same thing. So I'm not going to get into, the specifics on that, but I do want to explain the difference in the mortgage and the promissory note. Okay. So often people refer to a home loan as a mortgage, but a mortgage isn't actually a loan agreement. It's the promissory note that contains the promise to repay an amount borrowed to buy a home. A mortgage is a contract between you and the lender that creates a lien on the property, the collateral. Some states use mortgages to create the lien, while others use the deed of trust or another similar sounding instrument. The mortgage or trust deed of trust give the lender the right to foreclose if they fail to make the monthly payments or follow along with the terms of that mortgage or trust deed and breach the loan contract in some other way. While mortgages and deeds of trust are similar because they're both agreements in which a borrower puts up the title to real estate as security, these legal instruments do have some differences. For instances, mortgages and deeds of trust differ in the parties involved and often how the foreclosure process works. And again, that's just because it varies on a state-by-state process, how some of these things play out in the courts and how the foreclosure process moves forward. But nonetheless, those are the documents that are going to be used. All right. So to sum that up, the mortgage is going to secure the property. So it's going to include the subject property, the legal description of that property, the purchase price. It's going to state in attorney lawyer language, and I'll show you an example here in a second what I'm talking about. It's going to state, what happens if the terms are not met within the promissory note, which gets attached to the mortgage or deed of trust. And the promissory note is the part that's going to lay out the terms. So how much money is being lent, what the interest is, or what the charge is to use that money. What are the terms of that loan are on the promissory note, which is connected to the mortgage, which gives the legal right for that lender to foreclose and take over that property. And again, you're probably going to be in first lien position on most of these, but I can get into that a little bit more as well. So let me go ahead and pull up a mortgage to start. So these sample mortgages and templates are available to Premier members in the Private Money Club. So you guys can pull these templates up and look at them. You can, if you want to use them, I would recommend having an attorney or someone professionally. And we do have an attorney that works in all 50 states that is going to do a special deal for Private Money Club members. He's an attorney that works with Brent Carlson in corporate capital. His name is Steve, and he can do mortgages and promissory notes, and he can get you a 24-hour turnaround. So if you guys are doing a private money loan or you're a borrower looking to borrow money and you need to get a mortgage and promissory note created for the first time, he can do that in a 24-hour turnaround. He'll tell you exactly what he needs from you to do it and get it right over to you. And then you can use that. And then typically speaking, I'm not an attorney, so double verify all this stuff, but typically speaking, once you have that initial mortgage and promissory note created for your area, you can usually just change it and use it over and over and over again for future deals. And then the important part is recording that on each deal at the courthouse, but we'll get into that. So let me pull this up. Okay. So what you see on the screen is a sample mortgage template. All right. So as you can see, we are ready. And every one of you that has ever purchased a home, this is just like what you see when you fill out all the loan closing paperwork. It's the same mortgage, the same stuff that is used over and over. So mortgage and assignment of rents. So this would just be a mortgage, one that would be used if there was a, if this was a rental property. But, after recording and return to the attorney or escrow office of where the money is going to be wired from the lender's side. So that way, that attorney or escrow agent will have the mortgage, the promissory note. They'll make sure everything's right. If everything looks good on there, then you'll wire them the money. They'll know what that money is being wired for. It's connected to this deal, and then everything will be recorded at the courthouse to make everything official. So that's the overall package of how this looks. So this mortgage and assignment of rents is made to be effective, whatever the date is, by whatever the company is, the company's address, whoever that borrower, whoever that company is. So put all the information in here of what's going on with that deal. Borrower in consideration of the loan and the original amount of, however much that loan is, evidenced by that certain promissory note. So you can see already in the second paragraph of this mortgage, we're already referring to that promissory note, because again, that promissory note's gonna have all the terms on it that need to be abided by, or else this mortgage instrument will kick in to protect that lender and their money. So the promissory note dated as of the date of this instrument, executed by the borrower, made payable to the order of lender. So yada, 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 right? All of the legal mumbo jumbo. So I'm not going to go through this again. I just want you guys to have an idea of what this looks like. It's very good to read through this though and start to understand some of this stuff. As a realtor for 15 years and having done many, many, many investment deals over the years, I've looked at these a million times. So if anybody has like a little questions or anything, happy to answer it, but it's good to familiarize yourself with these things. And again, they can get long, so just kind of start going through it. But basically it just lists out what's going to happen if something does not happen the way that it's supposed to happen. All right, so that's the mortgage. Now, I want to pull up the promissory note because we can get into a little bit more with that. And again, a promissory note is a little bit, it's more of a simple document because it's really just laying out the terms of what's going to happen. And then the mortgage has all that, legal stuff within it. So this is an example, a sample, a template of a secured promissory note. So the date, how much money is being loaned or borrowed, what the maturity date is. So most promissory notes are going to be 12 months. Sometimes you'll see an optional extension for another 12 months. Sometimes you won't, but almost all of them will be for 12 months with no, what's called a prepayment penalty, meaning the borrower has up to 12 months to follow the terms in the agreement and pay back the principal investment. After 12 months, if they don't apply by that or return the money, then that's when the mortgage will kick in and you could start a foreclosure process per the terms of that promissory note and mortgage. But basically the borrower has that amount of time. And then if they pay it off earlier, which those of you who have lent out to most of the borrowers in the private money club, you've had your money returned. For instance, Chris Root deals are often returned in 3 to 4 months. So he has up to a year, but a lot of times that money will be returned a lot quicker. So when you're talking with the borrower, ask them, like, what do you expect this deal to do? Do you expect it to sell in 3 months, in 6 months, in 12 months? What do you expect it to do? But this is what this is typically going to look like from a promissory note standpoint. And you can make that anything you want, really, right? This is all negotiable. This is all terms of this thing that you're going to talk about. So what is the interest rate? And then, where is that property located? And if you guys have seen our trainings before, this is exactly what we talk about. What do you put on a promissory note? What is protecting your money? Well, you need on there, how much are you lending? How much are you charging for the money? What are the terms? Like, is it going to be paid back interest only? How long is it going to be? That maturity date again? All that stuff goes on to here. So this gives the information about who the borrower is. This is going to say who the lender is, plain and simple. And then this is the address, the property, the subject property address goes right here. Now, therefore, in consideration of the mutual promises and covenants contained herein, to induce lender to fund the loan evidenced by the insurance of this promissory note, a borrower covenants agrees and represents and warrants as follows. So it's saying the borrower will do everything on this contract below or else. So obligation to pay. For value received, borrower, meaning the money that's given to them, borrower promises to pay lender in United States money, the principal sum of written out dollars or notwithstanding with interest, which will be highlighted again up here in the summary, as well as it'll be put down here. So will be paid back along with interest in accordance with all the terms and conditions set forth herein. So again, those terms and conditions are going to be set down here. and it's all negotiable. Lender will lend according to the attached draw schedule. So not all private loans have a draw schedule, but some of them do. So when would a draw schedule be handy? Well, for instance, if you're doing a large rehab project, right? Maybe, so I've seen some deals pop up. I'll give you a real world example of one. So I've seen some deals pop up. Devin Burr had one recently. Okay. So he had a lender that was going to lend on the bulk of the loan. These are not real numbers. I'm going to give you an example. So let's say it's $900,000 for the deal total. He has a private loan or other. He has a loan on the property for $800,000 of the $900,000. That $800,000 is in first lien position, meaning if something goes wrong with the deal and the mortgage kicks in, the first lien position holder is going to recoup their money before it moves on to the second lien, the third lien, the fourth lien, etc. So it goes in order when it comes to liens, okay? So as a second lien position holder, you're behind the first lien, but it doesn't necessarily mean it's a bad deal. And in this example, for instance, there was enough money in the deal where if something was to go wrong, the first lien lender would have been able to get their money back, and there would have been plenty of money left over in the deal for the second lien position holder to get their money back as well. So if I look at that and I'm okay with that, then I'm still going to lend on that deal, even in second lien position, just because I know that my money is still protected. But if I'm lending $100,000 in a second lien position, why am I doing that? Why am I not lending on the deal? Well, in this case, the $800,000 covered the purchase cost. The $100,000 is covering the rehab costs, okay, of this deal. So if I'm lending $100,000 only on the rehab cost of this deal, I want to make sure that that borrower is using my $100,000 in the way that they are supposed to be using it. Okay. I don't want to give them $100,000 and then they throw a coat of paint on the walls and then they dip out with my other $99,500 or whatever. Right. So I want to make sure that they're doing what they say they're doing along the way. Maybe their rehab is going to take 6 months. So what a draw schedule does is it lays out those terms of that loan. Again, it's all about the terms, and all that can go into here. So maybe it says, I'm lending you $100,000, but I'm going to give it to you in chunks of 25,000. So the first 25,000 I'm going to give you by 30 days from now needs to be used for, the tear down of the house, ripping out the drywall and ripping out the flooring and ripping off the roof and all that stuff. And then my next 25,000, as long as all that is met within the 30 days, then I'm going to be able to give you the next 25,000. And that's going to say, okay, that's going to be used to purchase all the material. And then once I see the receipts that all that was purchased using that, then the next 25,000 is to get the actual work done to start putting all that back together. And then, okay, now I see the walls are up, the paint's down, the new roof is on, the floors are in. Now I'm going to give you the final $25,000 to go in and do all the appliances and do all the finishing touches on the property, all the features, the lights and all that kind of stuff, the crown molding that are going to make it, to bring it all together, that are going to give me that $1.3 million price tag that I'm looking for on this property that I have $900,000 in. I'm looking to make $150,000 profit on flipping this property, right? So that's what a draw schedule is. It's releasing the money on certain terms. And as long as you have all that built in, you can even have an escrow company or the attorney facilitate that. So the attorney would look at the contract, the money would be sitting in the escrow account, and then as the contract is fulfilled and as that draw schedule is fulfilled, the attorney will release the money from the escrow account to the borrower so they can continue the process. So hopefully that makes sense to everybody. If not, put it in the Q&A box and I'll answer it in a minute. Okay. So lender will lend according to attached draw schedule. And if there's no draw schedule, you just NA. Not applicable, which is incorporated herein. A borrower acknowledges and agrees that the lender may transfer this note to a servicing agent. All references to the lender herein shall also be deemed to refer to not only the lender listed above, but also the note holder who takes this note by transferring is entitled. So it's just saying, I'm creating the note, but maybe it's a 5-year note, right? And maybe next year I'm like, all right, well, I don't want this note anymore. I'm going to sell it. So maybe I'm getting 12% returns. I can sell that note for a price. I can sell that note for a less interest. I can sell it for 10% and I keep the 2% going on forward. Like there's lots of different ways to buy and sell notes. If you ever want to learn about note investing, Kevin Shortell is the man. If you guys have been to our Money School Essentials 3-day, you've met Kevin and seen him present, but he's awesome. So, he can definitely educate you, and notes are a really cool way to passively invest as well. So this is just giving us the right to be able to sell that note just like the banks do. Okay. Banks rarely hold on to mortgages and notes. They sell those things almost immediately when they issue them. So the exact same thing. Again, all we do is mimic what the banks do most of the time. All right, so loan documents. So what documents are included in here? So the indebtedness evidence by this note is further evidenced by a mortgage or deed of trust. So again, this is connected to that mortgage or deed of trust, whichever is applicable. The security instrument, a personal guarantee, knows the guarantee, and such other documents as may be requested by the lender in connection with making the loan evidenced by this note. Collectively, the note, security instrument, guarantee, and such other documents as may be requested by lender in connection are known as loan documents. So interest, this is going to lay out all sums from time to time owing herein shall bear interest from the date hereof at the rate of 10%, 12%, 8%, 15%, whatever it is. Write it out right there. Actually write, actual letters, write it out, and then put the number percentage right there. Per annum simply means annually. And in this case, it's going to be based on a 360-day year. So what that means is if you lend somebody money and they return that deal in, let's say, 2.5 months, you're going to do that calculation. How many actual days did they have the money out? Divide that by the 360 and divide that by the percentage. And that's going to give you how much interest is actually owed over that amount of time. And if they're paying you monthly interest payments, and you're halfway through a month, then that's what's going to determine and calculate how much is owed on that final half month of interest payment that's owed to you. And you can change that if you'd rather it be calculated on a monthly basis or whatever, but that's what that means right there. So how do the payments work? Borrower shall pay monthly interest only payments. Sometimes people, for different reasons, maybe you want all the interest paid up front. Maybe you want all the interest paid on the back end. Maybe you just want the monthly interest. Maybe you want the interest only payments. Maybe you want to amortize that loan and get some monthly and principal and interest payments coming in. So there's different ways to do it. In this example right here, this is an interest only, but this is where that information would go. What happens if they miss a payment? Good question. So what happens? What is it considered late? In this case, after 5 days, there's a $100 fee tacked on for every day that it's late. Prepayment. So again, all of the this is what I talked about before, no prepayment penalty. All of the principal balance owing under this note or any portion of the principal balance may be prepaid without penalty at any time without penalty. So maybe if you wanted to make somebody hold the note for 12 months and not be allowed to prepay it, which as a borrower, you typically would never do, but let's just say that happened. That's where that would go right there. What happens if you need an extension? What needs to be filled out and completed? What happens? Security. This note and sums evidence here are secured by the security instrument dated as the same date of this note, executed and delivered by borrower to lender. Borrower agrees to perform and apply and comply with all the agreement's terms, conditions contained in the security instrument. Again, what is the security instrument? The mortgage or the deed of trust. Okay. So you want it to be dated on the same date, and they're going to be executed and delivered together. All right. Event of default. So what happens if the terms on this note go into default? What happens if the borrower does not comply with what they're supposed to do? The occurrence of any of the following constitute an event of default. So any of these things can happen, can cause a default. Any event of default on this note that is not fully cured following any applicable notice and or prior to expiration of any applicable grace or cure period. So it just goes through all the different ways that this note could default. Then again, if it defaults, the mortgage kicks in, which gives them the right to foreclose. So it just says a judgment, writ, or warrant of attachment or execution. So you guys can read through this. But it's protecting you. Again, protecting you, protecting your money. Very, very, very important. All right, lenders remedies upon default, acceleration. So, what can happen, or what are some different options? Maybe you have some options you want to offer instead of foreclosure. Who pays for costs and expenses in the case of a default? Is there any forbearances allowed? Forbearance was a big thing last year with COVID. I heard a lot of mortgage companies and things like that offering forbearances. So what would happen in that case? Again, we use the exact same documents these banks, mortgage companies, loan companies use. Exactly the same. Different waivers, commercial purposes, usury savings clause. So all this stuff you guys can read through. A lot of this is, again, just legal mumbo jumbo, but is very, very important. And then we start getting towards the bottom. This is where the borrower is going to initial that they understand what happens for defaults and late charges. Any kind of schedules or exhibits. So this would be like the draw schedule or any other part of the contract or promissory note. That this is where that section would go. You would just attach it to this in this section right here. And then borrower acknowledges receipt. And then the borrower signs, dates, and depending on where you are, certain states require a notary, some don't. So depending on where you are, whether you need a notary or not, I guess New York does. I know most places don't require the notary. And you'll notice the borrower signs this, not the lender. So this is directly tying the borrower, or this is directly committing the borrower to follow everything on here. You're lending your money through the mortgage. This is telling, this is connected to the mortgage, telling the borrower what the terms are of that loan that they need to abide by. So plain and simple. And that's why the borrower is the one that signs this document. All right. So that is a sample promissory note. And I know that many people on here in the Private Money Club have seen that promissory note, because that's the same promissory note we use on a lot of these different deals. So promissory notes, somebody just asked, the cost of a promissory note. You can use, if you're in the Private Money Club, you can use this sample. You can use this template. Maybe you hire an attorney just to review it for you, pay $100 or $200. Maybe they charge you an hour to take a look at it and tell you it's okay for your state. It's going to be between $400 and $500 if you're brand new and you want an attorney like Steve with Corporate Capital. If you want him to do it for you, create the entire mortgage, create the entire promissory note, brand new from scratch for you on the first one, it's going to be $400 to $500. But again, a couple things on that. Number one, once you create the first one, can you use that same mortgage and promissory note over and over and over again? Why not? Right? Absolutely, you can. Now, if it's in a different state, the deal's in a different state or something, that might be different, but why not, once you have the initial one, use it over and over again? Also, who do you think should pay for that mortgage and promissory note to be created for that first loan in a new relationship? Would you pay for that as the lender, since you're protecting your money, or would the borrower pay for that since they're borrowing the money? What do you guys think? Borrower or lender? Who would pay for that initial mortgage or promissory note to be created if you need to get one created for your first deal that you do together? Shauna has no idea. Okay. Good. Split it. Yeah. Again, there's no right or wrong answer to this. It's kind of a trick question. I always make the borrower pay. My opinion, if they're brand new, they don't have this stuff already ready for me. They don't have the experience with it, or it's a new relationship. They need the money to get the deal done. I'm lending it. So maybe instead of charging them a point or two maybe I just say, hey, listen, I'll lend the money at 12%, no points, but I want you to pay the $500 fee to the attorney to look over the mortgage, look over the promissory note, make sure everything's done properly. Depending on the attorney or closing attorney or the escrow company that you're using for the closing, a lot of times they can look over the mortgage and promissory note for you as well, including in like the closing costs. So this isn't something you have to always, but again, it's always negotiable. So I like what Greg said, split it. That is very fair. 250 from the lender, 250 from the borrower. But I do like the coming out of the borrower side, because the other thing you can do if you don't want to stick it to the borrower is it just comes out at the back end. So no points up front, 12% annual, interest only payments during, at the return of my initial investment. When the deal closes and you cash out of it, I want my principal investment back along with $500 to recoup for the attorney fees at the start. So build it on the back end. That way, the active investor doesn't have any extra money they're putting out right now. And when they profit $20,000, $30,000, $50,000 on that flip, the $500 they got to pay extra at that point, it doesn't really matter, right? So different ways to build that in and different ideas on how to do that. But it's always a good idea, especially in that new relationship, to have an attorney look at this stuff. Again, it's all about protecting your money, lowering risk versus reward. This is all stuff that goes into it. All right. It won't be able to stay. Okay. Yeah, Georgianal, we can send you. Just go to privatemoneyclub.com and you should be able to see the beta trial on there. It'll be for our basic membership on there. And then the premier membership will be an option for anybody down the road that's not already a premier member. All right. So a couple more things that are very, very important. So we have the mortgage. We have the promissory note. Okay. So we talked all about that. This is protecting your money, protecting your money, protecting your money. Now, once we have these completed properly, they're approved by the attorney, everything's good to go, they're signed. There's a couple other things that go into private money lending that are very important that you need to do every single time to make sure that your money's protected and to make sure that everything goes smoothly. So number one, okay. So you only want to lend to entities. All right. So what I mean by that is if you're a lender, talk to your accountant or your CPA or whoever, whether it makes sense for you to lend money from a company or from yourself personally. A lot of times it doesn't really matter, but unless you're doing a ton, but a lot of times, like I'll just lend the money directly from myself. It doesn't matter. So you can lend from however you want, but when you're lending to the borrower, only to entities. Okay. So if I'm lending my money to Greg, for instance, I'm not going to lend the money directly to Greg Hammond. I'm going to lend the money to Greg Hammond LLC or whatever his company name is. Okay. So only lend to entities. And one of the main reasons for that is the Dodd-Frank Act. When there was a bunch of regulation that happened over the 2008 thing, this is one of the things that was in there with the Dodd-Frank Act and everything. And what can happen is if you start lending to individuals, they start auditing, they can actually consider you like an actual bank or finance company. And so it becomes real messy and dirty and get in trouble with the SEC and stuff like that. So only lend to entities. Number two. Okay, number two, I'm never going to wire the money directly to Greg Hammond's checking account, for instance. Okay. I know it sounds silly, but it can become very easy when you're doing these, especially if you're doing a bunch of deals, to be like, all right, listen, I trust Greg. Okay. Hammond Eggs LLC. Perfect, right, Greg? But it's very easy to say, okay, I trust Greg. Let me just wire the money directly to Hammond Eggs LLC business bank account. And then he can take the money and he can get the deal closed and get the deal done and everything like that. We never want to wire money directly to a person or a company. We want to wire the money to the entity through the attorney, the escrow company, or the closing company. Okay. So the attorney or the closing company or the escrow company, whoever's closing that deal, that's who we're going to wire the money to. Okay. Because then they're going to receive that money into the escrow account. They're going to verify everything on the mortgage, everything on the property, everything on the sale contract, everything on the promissory note, everything on those collective documents that go into purchasing a home. All of that is right. And as long as all of that is right and everything's signed properly, then that attorney, closing company, or escrow will release the money from that escrow account to the seller and get the deal closed the right way. Okay. So that's how you're going to make sure you're protecting your money that way. You're not just sending it out there into the universe and trusting people. So you're sending it that way. Number 3. Okay. In that mortgage, there's going to be a section that lays out what's going on, what happens with that property, and with the promissory note, I could show it to you on here, but I'm not going to bring it back up right now. But on that promissory note in the terms, there's an area, and banks require this too, right? Banks, if you have a bank loan, you're required to have insurance on that property, right? So us as a lender, we want to do the same thing. So in that note on that mortgage, we want to make sure that there's a clause, there's a section in there that requires them to have insurance on that property. And we want to make sure that we are listed as additional insured on the insurance on that property. Okay. So we want to make sure that that's in there as well. Very, very important. That's in here. So you're going to require that they have insurance on that property and that you are listed as additional insured for that insurance. So what that does is, Greg is in the middle of a rehab project. He hired some contractors to rewire the house. Those contractors at the end of a long week leave that house with a hot wire connected. All of a sudden the hot wire, an animal runs by, the hot wire touches something, it sets the house on fire. That fire goes and burns the whole place down, right? It's no fault of Greg, nothing he did, no fault of the contractors necessarily. It was an honest mistake. But if that house burns down and you don't have any insurance on it, you're out. Or if that house burns down and they do have insurance on that property, but you're not listed as an additional insured, who's going to get paid the insurance? Greg would, not me as the lender. Greg gets the money. So what if Greg gets that money and just says, all right, I'm out of here, right? You can foreclose on the property, but you foreclosing on a home that was burnt down in a fire, is that going to be good for your return? No, you're going to lose money, right? So the way you protect yourself in the case of an accident or a natural disaster or anything else that could go wrong, right, is by listing as additional insured. And what that means is if that house burns down, the insurance company is going to pay you out on that property, either instead of and Greg, who's listed as who has the actual insurance policy. So that's how we're going to protect our money that way. And then I mentioned this earlier, one final step to make sure that all of this comes together. You're going to go and you're going to record all of the documents at the courthouse. Now, a lot of times the attorney or the closing company or the escrow office will do that for you, but you want to verify. Or if it's a smaller deal, maybe more intimate, maybe you need to go down and do it, or somebody needs to go down and do it. But this needs to get recorded at the courthouse because these documents at the courthouse are, legally speaking, what are going to be followed in the case of a default or if something happens to that deal. Okay. So you want to make sure that's there, because if none of that's recorded at the courthouse and something happens, somebody's going to go, an attorney's going to go and look this stuff up and none of it's going to be there. And they're just going to say, okay, well, there's no documents on this deal, so we don't have any leg to stand on in the case of something happening. So make sure that that final step gets covered. But these right here, this is the most important stuff you can do to protect you and your money when you're doing private money lending, and it's very, very important. So if you have any questions, put it in the Q&A box right now, and then I got a couple more things I'm going to go over, and we're going to start to wrap up for that. Okay, so real fast on Private Money Club. If you go to privatemoneyclub.com, you're going to be able to create a basic account. That's going to get you in and get you access to some of the videos. You're going to be able to start looking at some of the different features and benefits the Private Money Club offers. I believe we have like one of Chris's books that he wrote. The private money guide is in there. And we're starting to add some other content and things in there that you get access to as a free basic member. And then when you're ready to start actually doing private money lending or using the perfect loan proposal or, borrowing money from the lenders within the community and starting to network and talk with the investors. And if you want some of the advanced education, like the 4-week master course and access to all these templates and documents and everything like that, as well as support from us and our team, then that's when you'll be a paid member. You're going to upgrade to Premier. Now, if you're already a Premier member, then what you're going to want to do is just give us about another week, and we're going to email out to you the instructions for you to join us as a Premier member, and we'll get you upgraded and start running everything through privatemoneyclub.com instead of Slack and Teachable and emails and all that kind of stuff. Okay. So all of that will be in Private Money Club. And we're really going to start ramping that thing up here soon now that it's getting created. So look for more and more coming out of that as we go. All right. So let me just check real fast. All right. So we talked about how to protect your money. We talked about the differences in first and second lien positions. We talked about negotiating the deals, how you can change the terms and allow for everything. We talked about promissory notes and mortgages and everything that you need to do to make sure that your money's protected. So let me ask some questions. Who records it? Either the attorney, the closing office, or you or the borrower. Somebody needs to go down and record it at the courthouse. Is the recording of the note additional, and is it recorded in the state of the asset? Yeah, it'll be recorded at the local courthouse, the local county that you're in. Additional insured, is this in the promissory note? Yeah, it'll be on the promissory note. It'll be in there. And the mortgage, it'll state, insurance needs to be required on this property in the promissory note section. Insurance needs to be and then just, you need to be listed on there as additional insured. You might even have to have it as a, you can write it in there, but what you want to do is you'll want to even have it added as a addendum on the contract. So the mortgage, the promissory note, have an addendum on there, and you can have the borrower send you over a sheet. It's called it's like a summary sheet. The name's escaping me right now, but it's like the summary or the statement sheet that shows the statement, or that shows the insurance on that policy, the in-force insurance. So it'll have the borrower listed or their company as the insured, and it'll have you listed as additional insured and what those amounts are. And that, what is the word for that, you guys? That insurance statement right there, you can attach it right to it. And in the promissory note of the mortgage, it'll basically say state insurance needs to be kept on this. And, me as a lender need to be additionally insured the entire time. So that way, if they call a couple of days later and take you off, now they're in default on the loan, right? And then you can go after them to recoup, and they can be held personally liable and stuff like that. So I hope that helps. All right. Does the lender need to lend from an LLC or just the borrower? So as the lender, you can lend individually all day long. You just want to make sure you're only lending to entities. So LLCs, S Corp, C Corp, whatever it is, but you're only lending to them, but you can lend as an individual. So Stephen Nagy would never lend to Ethan Direct. Stephen Nagy would lend to Ethan E LLC all day long. Sole proprietor, I'm not sure about. I might have to check into that, but single member LLCs are perfectly fine. It just has to be an entity. I would say don't lend to a sole proprietor. Actually, single member LLC though is fine. All right, guys. I think we made it through here. Any last questions on the perfect loan proposal, on Private Money Club, private lending, anything that we talked about here today? Charles, I never got an email from you, buddy. Maybe email me one more time, or maybe I somehow overlooked it. If I did, I apologize. I'll put Charles. I'll put my email on here one more time. If you guys do need anything, just email me, snaky@chrisnaugle.com. and then privatemoneyclub.com. All right, guys, thanks so much for being here. We'll see you next week on Wealth Webinar Wednesdays. We have, I believe, Solomon coming on to talk about 1041 tax reporting, which you guys in the past who have seen it, we don't record these. So you're going to want to make sure you're on live with Solomon. And he does an incredible job talking about how to use charitable trusts, foundations, to basically eliminate taxes. But he does something called 1041 tax strategy, and it's fascinating discussion and presentation, and it's not recorded. You can't watch it anywhere else. So you got to be here live next Wednesday. Thanks for being here. You guys have a great day and a great week. Talk soon.
All right, if you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel, and don't ever forget to smash that alert button. We'll see you on the next one.